So much to talk about here, but I think we do have to start with what we're seeing in energy markets, unprecedented volatility, and how it's rippling out across asset classes right now.
Good morning, Morgan. Absolutely true. We have oil prices have been all over the place in the last 12 days since the war started. And I think the very big question we're all posing to ourselves is whether this will be a short-term conflict or a long-term conflict, because they'll have very different consequences on energy prices and inflation as we go ahead.
What are you expecting? How are you navigating it and positioning for it?
We expect right now for this to be not the shortest term, not sort of the next day or two, but for it to take potentially another couple of weeks before things potentially the war stops. Now, that scenario may not work as well as we expect it to be, but with that scenario, the volatility that we've seen will probably continue. But what the IEA is doing, the big announcement today, to bring in the biggest stockpile that they've ever done is going to have a helpful impact on the market. Nonetheless, there are going to be a lot of disruptions because even if the war ended tomorrow, it's going to take a little bit to get all the oil back on tap. And a lot of the fields, depending on how they've been closed down, may take another couple of weeks to be brought back on. So disruptions we expect will continue. The short-term disruptions will continue. And one other thing I think, Morgan, that is worth mentioning is we talk about oil prices, but a lot of other prices are getting disrupted. LNG prices, of course, fertilizer prices. Those, if they go on for a little bit longer, are going to impact food prices and even just the delivery of food itself. The big change, of course, is in jet fuel, which has jumped hugely, and travel prices will get impacted. So we have to watch all these trends very carefully.
Yeah. And I want to get into all of that a little bit more. But first, just to go back to, this potential IEA largest oil reserve release in the history of the organization here. Just a little bit of math, according to one trader in a note overnight, that would still only cover about 9 days, give or take, in terms of the losses that we're seeing in the Strait of Hormuz. So I guess it raises the question, just how much would a strategic release actually help this market right now, or does it just buy time?
You're so right, because the fact that they're making such a big release itself could impact markets. People would get just scared just by that fact itself. And as you said, the amount of energy that is stored is fairly limited. So it's not going to be something that tides over for a very long time. The other thing is how it impacts different regions is going to be very different. We're seeing just depending on supply demand in the various markets in Europe, in Asia, particularly those who are getting LNG, for example, from the Middle East, who have been hugely disrupted, having to pay higher prices. So this IEA stockpile reserve will be helpful. It will be a psychological help, just like when the president came on and said this war will be short term in the last day or two. It impacted markets so that crazy volatility that we had on Monday got lower. But I think we just have to expect a lot of the things that we've seen as long-term, as the tails and the risks being sort of at the tails of markets, becoming average everyday events, i.e., we just have to see that markets are going to be much more volatile as we go ahead.
You know, it's interesting to hear you say that, because there was a report in the Wall Street Journal overnight saying that Citadel, Millennium Management, Point72, a number of others were actually hit by all of this market fallout and the massive volatility we've seen, not only in energy markets here, but also what we've seen in the bond market and with a move in treasuries, for example, over the last week as well. I think they were citing, $1.5 billion losses last week for Millennium and Point72 as well. When you see the so-called, and I use this word a little bit tongue in cheek, but like when you see the so-called smart money getting hit so hard by this volatility, what does it say, to your point, about how you need to assess risk in this environment moving forward?
So everyone is trying to have a more diversified portfolio to deal with these kinds of shocks. I think what the last couple of days have shown us is that there was very few places to hide in equity markets or in bond markets, as you just said. I think the question is the short term versus the long term. So the short term, absolutely, they did get hit. I think the bigger term trends in the market remain in terms of the inflation pressures that we're seeing, obviously oil and gas making it worse. The second thing that these funds will have to look for is what will happen with job markets. Consumer number that is coming out today probably will not be very meaningful because it's still February numbers and it's probably going to be in line with expectations. But March numbers could be very different. So on the one hand, I think if you look at the hedge fund performance in the last couple of weeks, in the last 12 days, you will see impact positive or negative in many of them. But I think a lot of them are positioning for much higher volatility going into this year.
How do you assess the impacts on inflation right now, given the fact that the environment is so uncertain? And not just here in the U.S., but when you look, to your point, across the globe and how the supply shock is affecting different countries?
I think this the bad word of stagflation has kind of raised its head again in the last couple of days, because we can very well have a scenario of inflation and if this war continues, as we said, if there is a scenario of it continuing a little bit longer, but even when it stops, for the disruptions to continue before they, different markets get resolved, fertilizer gets into places where it needs to, LNG markets get settled down, etc. All of that will mean inflation numbers will be higher. We heard the IEA we heard the ECB, for example, say they went from being relatively neutral to potentially increasing interest rates. So with that kind of market expectation, more likely that interest rates will stay where they are or go up, more likely that will impact credit markets. And also with the equity markets, there was really no place to hide again. We saw Asian equities do well last night, while the European markets did not open so well. We're going to see these kinds of sort of up and down markets a lot, I think, over the next couple of weeks. But the longer term numbers will be much more impacted with the longer term inflation, and also what AI will do to jobs and employment, which is something which in the last 12 days, I think people have been talking about a lot less.
Yeah, I just have to ask you that before we wrap this up, because that is in the background, this notion of AI disruption and impact to private credit on the other side of it, too. And as somebody who has invested in some of the startups that are on the front lines of this AI revolution, and somebody who has implemented some of this technology in your own firm, how do you see all of this coming together right now?
So interestingly, a lot of the investments we've made in energy innovation, including in SAF, including in processes that make energy more efficient, manufacturing more efficient, those are doing particularly well. So diversification in that way has been positive. I'm sure nuclear energy, modular nuclear energy, those are the things that, as people see this kind of crisis over the last 12 days, we'll be looking at even more. In terms of other kinds of, I think, innovations around AI, those will be super important. Maybe the infrastructure part, the data centers will get impacted a lot, but I think the startup business and the startup venture area around AI will be a very exciting area as we go into the rest of the year.